Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking European equities and my guest is Ankit Gheedia, Head of Equity and Derivatives Strategy for Europe at BNP Paribas. After turbulent times in the first half of the year, European equities have rallied off the lows they saw in June. The rebound puts the Stoxx 600 up around 10% since then, but 9.4% down for the year so far, though that is marginally better than the S&P 500 if, in the quarter to date, it's seen gains of around 13%. To compare other metrics, a PE of 12.47 for the Stoxx 600 and dividend yield of 3.21% are both, on the face of it, more favourable than the S&P 500 equivalents. We should also mention, of course, that there are ETFs which track the Stoxx 600, such as the iShares Stoxx Europe UCITS ETF and the SPDR Euro Stoxx 50 ETF, tracking some of Europe's biggest blue chips. Well, one question investors in Europe and elsewhere are grappling with is a recession priced in, and should it be? Not forgetting, of course, the interest rate outlook, with a triple hit of major hikes expected from the ECB, the Bank of England and the US Fed in September. So let's put that question to Ankit Gheedia, Head of Equity and Derivatives Strategy for Europe at BNP Paribas. So if we look at the macro picture, it's not a very bullish backdrop. Do you think investors are pricing in enough the chances of recession here?
So up until a month ago, when Euro Stoxx 50 was trading at around 33.50, we would have argued that investors were pricing a small recession in Europe of up to 20% earnings compression. But with the risk-on rally that we saw over the past few weeks, which has continued up until the end of last week, I would argue that some of this recession risk premia is now out of valuation. That said, European equities still look particularly attractive against US equities in terms of price earnings and dividend yield, as you rightly pointed out.
But if there were a recession, what could, in the worst case scenario, happen, do you think?
In that scenario, we could have Euro Stoxx going back to where we were up until a few weeks ago and stay there or rebound as we see the recovery. But what is more worrisome is what happens with the gas prices over the next few weeks and months, given that current elevated level of gas prices that we have in Europe. And that has a potential of causing a recession similar to what we had in 2020. I don't think that is in the price. In a scenario like that, we could have Euro Stoxx 50 going under 3,000 in our view.
Well, another possible elephant in the room is the path of monetary tightening from the ECB, the Fed and the Bank of England. All three are expected to deliver fairly big rate hikes next month. Do you think Europe is better placed to withstand that than the US in terms of equities?
I would think so. The reason why I say that, because at the start of the year, when Fed turned hawkish, and if you remember, within the first week, we had a big correction of US equities led by tech sector on the back of Fed pivot to hawkish direction. At that time, S&P was trading at a much higher P ratio than what Europe is trading at today. So the valuation derating of Europe has already happened. So from that perspective, I think Europe is much better positioned to handle a hawkish ECB.
Let's turn to sectors. You like energy, oil and gas and so on. That's despite all the risks. Is there also another risk that perhaps we've seen the best of the gains for that sector?
In the US, maybe yes, but not so much in Europe. In Europe, oil and gas sector is the only sector in green, and it's the best performing sector of this year. But if you look at the free cash flow yield for the sector, it's in double digit. This free cash flow yield is getting spent on dividends, buybacks. They're rewarding investors, equity investors, for holding the shares.
You also stress the importance of what you call the quality factor. What is your thinking there, and where do we look for quality?
So quality factor has underperformed this year, both in US and in Europe, on the back of higher interest rates. The growth factor could become dominant again and could lead the next leg of equity market rally. In Europe, what that means is tech sector, luxury goods sector, which we think still has room to perform. Their earnings have been okay, but the reason why they have been one of the worst performing sectors in Europe is on the back of higher bond yields, which we think should take a pause.
And you see financials and banks trading at something of a discount. Is this a good time to move into those?
I think we may need to wait till the end of winters to get convincingly long European financial sector. This is one sector where we clearly see high double-digit upside in the next 2 to 3 years, given where the valuations are, given where the profitability could be, given by the fact that ECB up until this time last year was in a negative rate environment, and we're not expected to go out of that anytime soon. And now expectation are for ECB deposit rate to be above 1% by next year. I think that's a very bullish outlook for European financial sector.
And presumably against a rising interest rate environment, tech is still not that appealing, or could it be at a bottom, do you think?
I think the rally that we have seen over the past month has been tech driven, and I think this momentum could continue up until the end of the year, particularly if Fed indeed hikes by 50 basis points rather than 75 in September, and then slow down further to 25 bips for the remaining 2 meetings of the year.
And you mentioned with regard to banks and financials that possibly it might be better to wait a little bit until the end of the winter before moving in there. Is that a general view that you would apply across most sectors, do you think?
I think I would apply that view to go long Europe versus US. I think I'll wait till end of the winter to go long European equities against US equities. For other sectors, I think value cyclical sector in Europe, they are trading at mid-single digit P ratio, and they would have similar, I would expect them to perform similarly to banks. So what do I mean by value cyclical? These are banks, autos, oil and gas, miners. I think these sectors are trading at very good valuation levels, and they could lead a very strong year for European equities in 2023.
Okay, Ankit Gheedia, Head of Equity and Derivative Strategy at BNP Paribas for Europe. Thank you so much for your time today and for those insights.
My pleasure. Thank you.
And that is your roundup of the European equity sector. I'm David Pollard, and this is Reuters.